I used to think Social Security was really just a simple monthly check that showed up when you stop working. And honestly, that's what a lot of people think right up until they actually look at the rules. It turns out Social Security is less like a light switch and more like a control panel. And understanding how this panel works can make a huge difference in how much you receive each month and over the course of your full retirement. I'm Jacob Euler, co owner of Grand Summit Wealth Management. Over the years, I've helped more than 100 individuals, families, and business owners retire with confidence while making smart decisions around income, taxes, and long term wealth. The rules, insights, and decisions that actually move the needle in real life, not just on paper. So, in this video, I'm going to be giving a big picture overview of Social Security in 2026. This is meant to be the foundation. In the next videos, we'll slow things down, go deeper into specific situations with real examples, so you can see what exactly makes sense for your individual situation. Social Security is one of the most important income sources for Americans, especially as you get closer to retirement. Even for high-income earners, it often plays a key role, not because it makes you rich, but because it's a guaranteed, inflation-adjusted income for life. And in a world where very few things are guaranteed, other than taxes and the cost of your streaming services going up, this kind of reliability can really matter. Now, getting the details right can mean more peace of mind, less stress about running out of money, and more flexibility to actually enjoy retirement instead of constantly worrying about cash flow. Let's start with inflation adjustments. Social Security benefits are adjusted each year through something called a cost of living adjustment, or COLA for short. Based on current estimates, the COLA for 2026 is expected to be around 2.8%. This means the average retiree could see roughly $56 more per month compared to 2025. While that's not life-changing money, over time, these adjustments can help your benefit keep up with rising costs. And while it may not fund a luxury vacation, it can help cover some of those rising beef costs we see every time we go to the grocery store. And these days, I think that still counts as progress. Now let's talk about when you can start collecting Social Security. The earliest age is 62, known as your early retirement age. Claiming at 62 permanently reduces your monthly benefit, roughly 6 to 7% for each year you claim before your full retirement age is reached. Claiming early can feel like free money, but really it's like buying your future paycheck on clearance. You get access sooner, but each check is going to be smaller for the rest of your life. For anyone born 1960 or later, full retirement age, or FRA for short, is going to be 67 for you. Claiming at full retirement age gives you your full benefit, officially called your primary insurance amount at that time. If you delay past full retirement age, your benefit increases by about 8% per year up until age 70. After 70, there's no additional increases. At that point, Social Security is really saying, we've done all we can for you, please enjoy the money and enjoy it now. Now, in that spectrum between starting to take income at 62 all the way until starting to take it at age 70, there is no universally best claiming age, despite what you may see on the internet. The right choice for you is going to depend on your health, your income needs, your marital status, your taxes, and what Social Security looks like in unison with the rest of your retirement plan. Your benefit is based on your highest 35 years of earnings adjusted for inflation. If you worked fewer than 35 years, Social Security fills in the missing years with zeros, and those zeros can really pull your benefit down. Social Security doesn't ask why you didn't work those years, whether it be because of career changes, staying at home with the kids as they grew up, going back to school to pursue a different career. It doesn't matter. They just calmly write down a zero and move on. The good news is that higher earning years can replace lower ones, and if you're still working, your benefit can increase even if you've already started collecting your benefit. Now let's talk about spousal and survivor benefits, because this is where Social Security stops being an individual decision and starts becoming a family decision. If you're married, one spouse can receive up to 50% of the other spouse's full retirement benefit if they wait until their own full retirement age. If they claim earlier, then this amount is reduced. This can be especially valuable when one spouse earns significantly less over their lifetime. Let's say one spouse did stay at home for a period of time to help raise the kids, or maybe they were even sick for a while and weren't able to work for a couple years. This allows that spouse to claim the higher amount, whether that be their own personal benefit or that 50% spousal benefit. Now, survivor benefits work differently. If your spouse passes away, you may be able to claim survivor benefits as early as age 60 or age 50 if you're disabled. Waiting until full survivor retirement age can allow you to receive up to 100% of your deceased spouse's benefit. Divorced spouses may also qualify as long as the marriage lasted at least 10 years and they haven't remarried. And many people actually continue to work while collecting Social Security. But something to know what that is, if you claim benefits before your full retirement age and earn more than certain income limits, Social Security will actually withhold part of your benefit. In 2026, if you're under full retirement age and earn more than $24,480, Social Security withholds $1 for every $2 above that limit, or 50 cents for every dollar. In the year that you reach your full retirement age, this limit increases to $65,160, and the reduction amount becomes $1 for every $3 above that limit, or 33 cents for every dollar. And this is going to only apply in that last year or the year that you turn full retirement age during that calendar year. Now, it's important to note this isn't a penalty, it's a timing issue. Once you reach full retirement age, the earnings limit disappears completely, so you can work full-time and receive your full benefits starting at full retirement age. And any benefits withheld due to the earnings test are not gone forever. Once you reach full retirement age, Social Security recalculates your benefit and credits you for the months your payments were reduced. Now, something that may be surprising for many retirees are Social Security taxes. It's a myth that you may hear out there that none of your Social Security benefit is considered taxable. In fact, depending on your total income, up to 85% of your Social Security benefit may be considered taxable at a federal level. If your total income for that year is more than $34,000, you do fall into that 85% benefit being considered taxable at the federal level. These tax thresholds have not changed since the 1980s, which means more retirees run into this every year, as most people make more than $34,000 in total in the modern day. Now, there's also a cap on wages while you're still working, subject to Social Security payroll taxes. In 2026, that cap is $184,500, so any income earned above that income amount is not considered to be subject to Social Security taxes. And starting in 2025, the Social Security Fairness Act eliminates the windfall elimination provision and the government pension offset, allowing many public sector workers to receive their full benefit without those reductions. Now, as you can see from all these intricate parts, timing your Social Security claim can be a very important strategic decision. Claiming early gives you smaller checks for life. Waiting until full retirement age gives you your full benefit. And waiting until 70 produces the highest possible monthly payment, but only if it fits into your overall retirement plan. Now, once again, this video was meant to be a big picture overview of some of the different aspects of Social Security. In the next video, we're going to zoom in on one of the biggest financial decisions people face: when claiming early actually makes sense for you and when it doesn't. Because this single decision can change your lifetime benefits by hundreds of thousands of dollars, it's a very important decision to be able to make. So if you found this video helpful, make sure to like and subscribe so you don't miss the next video in the Social Security series. And if you're approaching retirement age or want help integrating Social Security into a broader financial plan, well, that's exactly what we do at Grand Summit Wealth Management. You can click the link in the description to book a financial strategy session with me or one of our other financial analysts, and we can start to see what makes the most sense for you and your loved ones. So thanks for watching, and we'll see you in the next one.